All right, testing 1, 2, 3. Can anybody hear me? La di da di da di da di da da da. If you don't respond, I shall sing. That would be torture. That's funny. I normally torture people. They play like really loud music so they can't sleep or whatever, like really play heavy metal or something like that. I'm like, just like have a really bad singer come in. I've been to plenty of karaoke bars where I want to shoot myself. In fact, just in Orlando, they had a karaoke night at the place I was staying, and I was like, "Holy crap!" I was just like, "That's so bad." I guess it's a cultural thing, you know. It's like it's fun, but not for me, frankly. And I'm a terrible singer. I shouldn't really criticize other people, but holy crap! So where are we? All right, what are we doing today? Dun, 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 dun. Oh, video, right? I gotta check the video. I forgot all about that. Knew there was something that was bothering me. Let's see. No one can see your screen. Click to start screen sharing. Okay. Let me know when that works. Let's see. We'll put some pretty charts. We can all look at pretty charts. How are we doing? Well, it's better than a little, coming off the bottom a little bit, but not too impressive. It was a pretty nasty drop. I'll tell you what the good thing is when I know that you can see me. La da da. Okay, video's good. Thanks, Corey. Thank you for participating. All right. Let's see. So these lines, okay, you got your and people ask me, so I'll proactively tell you, when you're in Thinkorswim, if you right click in the middle of the chart, it gives you all this crap, and then it's a study, and you can add study, and this would be a trend study, and it's called pivot points. See down at the bottom there, it says pivot points. So that's the study it's the only study I use, frankly, because it's actually quite good. It's based on the Fibonacci calculations. It's based on the average of yesterday and the volatility of yesterday. It's a clever little calculation that figures out what the most likely range is going to be for the next day. And so you have your most likely track, which, you know, it's completely random whether it works or not, but the range works. In other words, it's not likely that you're going to go outside of the range. So what you have here is what they call, this is called support 1, support 2, and that's called resistance 1 and resistance 2. And it's not likely that you go outside of the range of either the second or the second resistance or the second the second support resistance, or I was trying to start support with an R and it wasn't working. I was getting stuck on R. It's the resistance or and I'm like, no, that's not right. It's not coming out. Anyway, just look, it's just like any other trend. It works until it doesn't. But this is a natural thing. So I like it, and it does tend to work, and you can tend to say, okay, we're probably going to get support there, we're probably going to get support there. It works well on the indexes. It doesn't work as well on stocks or commodities because they're more likely to break out of their zones. Like your gold's already off the rails over here. And actually, when you see these things tightening up, it's actually more likely to break out when they start tightening up. I'm not sure because you had a tight range yesterday, so the lines tightened up. But that's more like a squeeze before breakout kind of thing. But anyway, they're good to look at and see and figure out, well, that should be support, and if it's not, we got problems. And the same thing over here, this should be support, if not, we got problems. So the good news today is on the Dow is stupid, so we don't care. The S&P held its support right there like a champ, right? And so did essentially the NASDAQ. The Russell was a bit weak and struggling to get back over the support is not good. It really needs to be back at this 2000 line though. I mean, it's just sad if it can't get back to 2000. But you know what's happening is you've got these small cap retailers. And this is what we were worried about. I mean, the small cap retailers and the basic little companies are calling in and they are reporting their earnings, and they are not having. I really got to figure this out. My matcha tea does not break up in the freezing cold water, so I have to choose either to wait for it to warm up or drink it with chunks of matcha. Or go back to drinking pre-made tea. So where was I? Yeah. Anyway, 2000, whatever Russell index is, bad stuff. Anyway, now every day I look and I say, am I going to give him a break? I am going to give him a little break because the dollar has gone up, not much, but the dollar came back up again. Yesterday it went down, so they got a little boost, and today it went back up almost, all the way back to where it was. And now they're depressed again. So basically it's a half-point swing here and a half-point swing here. And the indexes basically we went up a bit and now we're going down. So so you would say we could erase this because we're back to where we started with the dollar. So we could easily erase this whole run that came up because of the dollar. But then what's all this about then? But the day's not over. If we get back to these lines, to this support one, I don't think it's a big deal at all. Gasoline, oil, and again, we were saying earlier, like I don't get it. I don't see why you wouldn't have a better reaction to that report. We had a massive drawdown in oil. Let's see. What? Time for more shaking. We'll get there eventually. Oh, that's pretty good. All right. So we were just looking at that thing before. And where's it going to be? Up here? We're going to bring it up somewhere, right? Petroleum status report. Let's first look at the raw numbers because it's easier to look at over here. Oof, there's a long post today. What is going on? It takes time to resolve. Oh, it takes time to resolve all these charts. So, minus 7.1 million barrels of crude. That's a lot. And minus 4.6 million barrels of gasoline. That's a lot. That's that's like a half a day's total supply. So that's massive. So why did that happen all of a sudden? Or last week was the other way. Last week it was disappointing the other way. So it's interesting that suddenly they were this. There it is. So petroleum status report. Okay, imports average 6.1, blah, blah, blah. Commercial crude decreased 7.1. Oil inventory 6% below the average. 6% not terrible. Total motor gasoline 8% below the average. That's, it gets 10%, you're a little bit concerned. Distillate fuels are 23% below the average. That's very concerning. That's jet fuel and stuff like that. Diesel, jet fuel, transportation stuff. How much is diesel? Does it say here? Diesel fuel. It's actually, I mean, it's 491, but it's worse than the other guys, but it's not horrifying. But I mean, seriously, you got to be concerned with 20%. Oh, look at this shit. Now they're exporting 4.2 million barrels a day. So they're exporting. See, here's the thing about that. The whole thing is caused by these exports. Oh, never saw that before. It's got like a flashlight effect. It can't be just me, right? I mean, when I click on this, See, everything moved to a thing. I swear that I mean, I really don't remember that ever happening before. Anyway, so 4.2. Now it's annoying me. Times 7. So it's 30 fucking million barrels a week we export, and we have a draw of 11 million, or not actually, more like whatever the hell it is. Distillate fuels increase. Yeah, okay, so call it 11 million. But we're exporting 30 million barrels a week, and they're claiming we are short on oil. Well, there's your oil. How much less oil is there in America than there was last year? Last year there was 1.8 billion barrels, and now there's 1.673. So we're down about 200 million barrels in 52 weeks. Is that correct? Yes. So obviously that times 52 weeks is going to be 100. No. In 5 weeks it's 150. I'm sorry. I'm sorry, times 52. This is why you need a calculator. It's 1.5. Okay, so here's the total oil reserves of the country. 1.6 billion barrels. I need to talk about this on Bloomberg. Here's the total reserves of the country. And here's how much we exported in the last 52 weeks. Probably not 4.2, but you get the idea. I mean, it's just insane. We've exported as much as all the country has in reserves. We shouldn't be exporting any if we need it, right? That doesn't make any sense. This whole project, the whole project doesn't make any sense. Let's see if anything funny happened. So, less oil was released from here's why the buildup is happening. The strategic oil reserve released 3 million less barrels. That's a big deal. All other oils went up 1 million, but the big deal is that there were 4 million barrels that were being released by the SPR. It's no longer being released. So that's why we suddenly had a draw on oil. They were doing a different thing. And they stepped up their exports. And look what else happened. Net imports of crude oil went down by a lot, by 400,000 barrels a day. So we imported less, we exported more, and here's your there's your net total. So net total 1.5 times 7, 10.5 million barrels. So this amount here, that's exactly where it's coming from, man. It's exactly here. We imported less and we exported more, and we caused a 10.5 million barrel draw. So in reality, is that a reason to be jumping into oil and running it up? No, not really. So the initial reaction was actually probably correct, but that's still not going to stop it. The headlines are what drives this thing. So they're going to make an effort to get back to 90, I'm sure. I just think it's too dicey to bet on overall. I don't see it. But so in other words, there's no surge in demand. That's the most important thing. There's absolutely in no way, shape, or form is this any kind of surge in demand. In fact, I pulled this up for an oil guy I was having a lunch meeting with on the weekend. And I pulled this up for him to tell him what bullshit the entire demand thing is. He starts telling me, oh, well, U.S. demand is this and that. And I'm like, no, it's not. And I got him to back off. And this guy was adamant that U.S. demand had been increasing. And I got him to back off and admit that it's the same 16 million barrels per day that it was 10 years ago. That there's been no change whatsoever in the amount of consumption in the U.S. There is no, and that his projections and everything he was doing was wrong. And he admitted to me that it was based on the wrong data. This makes a huge difference. And this is an oil guy. He had absolutely no idea that this is going on. But when he saw it, and when I pointed it out to him, he's like, oh, shit. He goes, that means this number is 4 million. It's a very simple concept. It means this number is 4 million less than you think it is. It means U.S. consumers consume 4 million barrels, 25% less than is commonly believed, because we're exporting it. We're not actually consuming it. And that is messed up when so much money is being placed on these bets. All right. Anyway, off of that. What else? What we just talked about is very important. News. Kinky says beyond text. I think the adjustment's a mistake. It wasn't a mistake. The way I said it was probably a mistake. Puts can be real. Let's sell. No, let's sell. All right. Okay. I shouldn't be clever when I say something. Yes, it's my intention to close them out. Okay, so where were we? Oh yeah, this, right. Okay, so I wrote just a little while ago. Everybody's freaking out because I'm getting more cautious, but I'm more cautious because I was bullish here at 3,700. I was bullish. I said this is undervalued. Okay, now we're here. And I'm no longer thinking things are undervalued. Now we are fairly valued. This is my fair value line. So when we're down here, 10% below the fair value line, I am more likely to want to buy things. When we start going into the range above 10%, but when we get towards the range of being 10% overpriced, I'm getting nervous, and especially because I don't see the upside here. Oh, this has got to be refreshed. Hang on. There. I'm sorry, we are here now. So there you go. This is where we are now. So when I was bullish was down here. When everybody else was screaming recession, end of the world, blah, 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 I was like, no, I see a lot of stocks that are really good values. Let's buy them. And that's what we did. Okay. This is freaking, I mean, what's the number? Is it 17%? I think 17.5. What's the number? We are talking 4,320 to use the lines minus 3,680 divided by, that's 640. It's getting around 20% divided by 3,680, 17.5%. So this is a 17.5% increase from where we are now. And it's not like a stock increasing 17.5% where you say, well, that's really good, but maybe it can do better, blah, blah, blah. An index is not that likely to improve 20% and keep going. That's a lot. That's, you're talking about trillions of dollars. And again, in a short period of time, you have to think about it like, where is this money coming from? All right. So, I wish I could draw stuff. Well, I probably can, but I'm not good at drawing anyway. So maybe that's a silly idea. It still would be better the blank piece of paper. Notepad, right? Is that a thing? Note. News? What? I thought you could make notes. Is that part of Office? It doesn't seem like it. Well, Word is. What on earth? Okay, go away. I thought there was like a little notepad. Oh, here you go. How about N-O-T, notepad? There we go. Ah! Okay, so. I don't know. I'm just going to play this by ear, but look. So, Frank owns a used car lot. And Frank has 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Frank has 100 cars. So, this is going to be messy. It would have been better on a spreadsheet. 3, 4, 5, 6, 7, 8, 9, 10. Be nicer if it's a square, right? All right. All right, so we'll do it that way. We'll do it down. So Frank has 100 cars, okay? Now, let's say they are Volkswagen Beetles at $30,000. Okay, and let's say the people in the town, so town, so in the town, there are, doesn't matter how many people, but let's say the entire expense of the disposable income in the town is, well, let's say the entire disposable income in the town is going to be what? 30 and 100 is 300,000, 3 million, so it's 3 million. Let's say the town has 10 million of disposable income, okay, total. And of course, that's going to be broken down by classes and so on and so forth, but whatever. So Frank expects that he has a reasonable chance of people spending 1/3 of their disposable income on his cars and buying them at some point, right? So that's fine. Now, if somebody comes and buys five people come in and buy cars, 1, 2, 3, 4, 5, right? And they pay $30,000. So Frank has now gotten $150,000 for his cars. And the town, and again, you know, given that there's no changes as far as it goes, the town still has the town has 9,850 left to spend, right? Now, again, assuming the economy didn't change much in the couple of days since then, and there's no new money's been created, nothing amazing happened, right? So on and so forth. All right. So now it's $150,000, and Frank will say, okay, well, I have I had 30 Beetles that were worth $3 million, and now I have 30 Beetles that are worth $850,000. I'm sorry, $2.22,850,000. Okay. Now, if for some reason people get excited about buying Beetles and they decide to pay 5x, they decide to pay 5,000 extra dollars to get them for whatever reason. They think there's a shortage, they're stocking up, whatever the reason, somebody's speculating on them. Now he's going to sell 5 more Beetles for 35,000, and now I need my calculator because it's confusing. So now it's going to be 35,000. Nice, no number lock. 35,000 times 5. Now it's 175,000. Well, I should have been able to figure that out. 175,000. All right, and now there's oh, son of a bitch. So 2,850 minus 175, 2,675. No, wait, 2,625. That's not right. Oh yeah, 2,675. Okay. See how you get there. So 2, 6. Well, I'm sorry. Because they got sold for 35, that was the point I was going to make. I'm sorry, because they are worth 2,675, because it's still freaking, you know, it still got the same amount of cars, right, to sell. But no, now Frank's saying, well, I have 90 cars left times, now I'm going to sell them for $35,000. So now I have, even though I sold 10 cars, I have $3,150,000 worth of cars. That's interesting, right? Because now he's got a sign that says Beetles $35,000. Now, if 10 more people come in and go, oh my God, I got to get these Beetles before they're all gone, they pay $40,000. So now Frank's collected another $400,000 for 10 more Beetles. Remember, it was before we were selling 5 at a time. So now he's collecting $400,000 for 10 more Beetles. And now he's got 80 beetles left, but his beetles he thinks are worth $3,200,000. Even though he's now sold 20 of the 100 beetles, he's got a higher price than he started with, because now he thinks they're worth $440,000 each. All right. The town, meanwhile, has spent the 175, so it's 850 minus 75. 850 minus 175 is 9675. So the town's 9675,000, and now they spent another 400,000, so they're 9275,000. Okay, and now the beetles are 1/3 of what the town has left if they want to buy them. And you see where this goes. So in other words, as they rise in price, and he keeps thinking his value is the same, the reality is the town is using up all its disposable income on the beetles. There's going to be a mismatch of what they can actually buy compared to what he believes they're worth. All right. So I mean, if you just take this to the next step, the next 10 go for 500,000. All right. He now thinks he has 500,000. He now thinks he has he thinks he's got 7, so he's got 3,500,000 left. He keeps thinking he's got more, even though people are buying it, right? The town is down to 8,775,000, okay? And now 3,500,000 divided by 8,775,000 is now 40% of the town's disposable income. So it's obviously an oversimplification of the concept, but that's what happens with stocks, right? People buy some stocks, yet the people who hold the stocks believe that all the stocks, and not only that, but stocks aren't destroyed. So when you buy the stock's still there, and these numbers would be much higher. So in other words, Frank would still have 100 cars, and now he thinks they're worth $50 each, so he thinks they're worth $5 million. Put some commas here. So he thinks they're worth $5 million, right? Because there's still 100 cars. It's just that people have been buying them. He's heard people have been buying them for this kind of money. So he's now put a $50,000 price tag on the cars, and there's 100 cars. And now he needs half of the town's money, just to, more than half of the town's money, just to fill out his orders. It's not going to happen. There are other people who also want the money from the town. There are other things to buy. There are other assets to invest in. So when you see a market where everything is getting marked up and you don't see an economy that is expanding, it has to collapse. There is nothing else that can happen. It has to collapse. All right, so what has actually happened in the last month to the economy? Nothing. We have had a terrible GDP report. Europe's had terrible GDP reports. Generally, everybody is lucky not to be negative. So we've had absolutely no GDP growth whatsoever. We've had some terrible manufacturing reports. All right, the consumers are spending, but they're borrowing to spend. They're not making the money. The money's not appearing. They are going further and further into debt to spend, just like in 2007 and 2006, when everybody thought everything was fine, because people were leveraging the shit out of their houses in order to keep paying, in order to keep buying things. That's what, and it turned out that the leverage that they were getting in the houses was wrong, because the housing prices were too high, because they were about to collapse, just like our housing prices will when mortgage rates hit 6-7%. They cannot keep going up. The houses become unaffordable again. There is no more money. All right. So when you see the market gain, let's say we have a 100 trillion market for argument's sake, it gains 17%. That's $17 trillion. That's our entire economy for a year. Our economy's theoretically 24 trillion. So it's not the entire 75% of the economy. So if you see in a month, the market goes up 17%, and the economy doesn't grow 17% or even 5% or even anything that could possibly justify that, then something is wrong. So now who's wrong? That's the question. Any questions on this, I wonder? Nope, nobody has any questions. All right, there goes Frank's used car lot. Don't save, cancel, go away. All right, so anyway, so this is a July 13th. I was on the TV at the time, right? That was when I was on TV. Now it's just a month later. And that's, well, from here it's a 15% run, from here it's a 17% run. So we're 15% higher. And see, the thing is, these guys were wrong for the same reason. Okay, we hadn't grown the economy enough to make it work. Now, what's been added in this time? $1 trillion worth of stimulus. $1 trillion worth of stimulus doesn't translate into $15 trillion worth of stock market value. It's not even a trillion, it's whatever the hell it was. But say, maybe, I think when all said and done, it's 400, 500 million, let's say, billion. So there's no growth, there's no stimulus, not enough stimulus. There certainly hasn't been any tax breaks. In fact, they just raised the minimum to pay for this stimulus. They raised the corporate minimum tax rate, thank God, best idea ever, to 15%. So in other words, the least taxes a company can pay is 15% now. Because it's bullshit when you see these companies that pay 10% and 12% taxes and whatever, and they play these games. It's like, fine, we don't care what games you play, give us 15%. You can depreciate whatever you want. You can take losses and carry forwards and blah, blah, blah. But we want 15% on the money you made. That's good. That's a good thing. Because corporations like so massively underpay. All corporations together paid 400 billion in taxes last year. The people of this country, the workers in the payroll taxes and income taxes, paid $3 trillion or $3.5 trillion. So corporations paid about 1/10 of what the people they employ paid in taxes. Yet they made more money. The corporations made $6 trillion, which is more than they paid their workers in total. So we shoulder 90% of the tax burden and make less money than the corporations. That's what's wrong with the entire economy. That's what's wrong with everything in this country. It used to be the other way around. Once upon a time, it was the other way around. Anyway, so that's my point. Anyway, so my point is, this was too high, this is too low, this is just right, and this is getting to the point where you have to start saying, whoa. Let's take a step back and very carefully evaluate these positions and think about whether or not they are now worth the risk. I know it seems like so soon because we just bought a lot of them, or we just got aggressive, and I just a month ago was saying, this is too cheap, that's too cheap, let's get that, this is stupid, this is a ridiculous price. I know I said that, okay? That was 15% ago. That is not what's happening now. All right, 15% is where you're marking up the $30,000 car to $35,000. It could go to 40, but 40 is already ridiculous. You know that 40,000 is not the price of a Volkswagen, not a Beetle anyway. And you know that you can get it cheaper somewhere else. That's how people look at stocks ultimately. Okay, I know a lot of people don't. I know people are buying frickin' Bed Bath & Beyond now for 100 times earnings. Isn't that funny? That's the stupidest thing, right? Because it's like a meme stock. And I like Bed Bath & Beyond. I like them when they're cheap. I don't like them now. They're not cheap at all. There is no earnings. See the PE ratio? There is no earnings. They're losses. But even theoretical earnings, even if you say, look, here in their heyday, they were dropping 5% to the bottom line. Okay? That's when everything's working for them, they're dropping 5% to the bottom line. Even if they were dropping 5% to the bottom line here, they'd be making $300 million. The market cap is 1.65 billion. So yeah, that'd be okay. But they've shown no signs of getting back to that for a very long time. They're actually losing this much money, and also, and oh well, we can see already. I'll tell you right now. Let's look at the debt. Okay, back here, they had $1 billion in debt, and they were paying it down. Now they got now they've added $600 million in debt since last year, and lost 600 million. Basically, that was it. Their losses were debt funded last year. Okay, they're losing $500 million this year. Where's it going to come from? They're going to be to 1.8 billion. If they have no money and they're losing 500 million and they're 1.3 billion in debt, where is it going to go? And how much is the interest on 1.3 billion? Okay, so they're going to pay, let's say they're paying 1.3 times 0.05. Say they pay 5%. That's 65 million in debt. So add that to this loss. And that number is going to go up as time goes on. So this is not really an investable company yet. Look at this shit. I mean, 5 was too low for sure. That was, you know, unless they were going to go bankrupt, 5 was stupid. But 25 is just as stupid the other way. You know, meanwhile, BBY, take out a B, and we got a reasonable company. Best Buy is $19 billion. They have $50 billion in sales, or $45 billion in sales. They make $1.3 billion, and you can buy them for 19. That's 12 times earnings. But they're actually making the money. Okay, and they've only got 500 million in debt. So who would you rather have money in? These guys are actually making money. So anyway, so you know, I'm always looking at whether or not something is investable now. And we were buying Best Buy back here, by the way. So we bought it quite a while ago when it was lower. You know, we used to have a Bed Bath & Beyond, and I frankly, I just couldn't. The last time it cycled down low, which is a shame because I should have thought about the fact that it was a meme stock and people go crazy for it. But when it was really low, even though it was that low, I was like, they're still not going to make any money. At some point, people get fed up with that crap, usually. You know, they have to have a hell of a turnaround to get back in shape. So anyway, so that being said, now we can talk about what we're doing in the portfolios. No, I was still going to talk about this. I didn't even get to it. Okay, so so Ukraine thing still going on, blah, blah, blah. Here's the thing. China's economy stumbles. So people in China, and I agree with them 100%, and I wish you could do this in America, but if they're right in jail, people in China who put money down and have to pay the mortgages off on pre-construction properties, right? So they basically, the way it works for these builders, which is a crazy deal anyway, is you pay the builder and they have a schedule, and you're paying your mortgage a year or so before you move in, 2 years before you move in, as construction is completed. But because these builders, so many of these builders are in so much trouble financially, they're not completing the projects on time. So the Chinese people, they're not really protesting the entire concept of the thing like Americans would. That whole thing is ridiculous. But they're saying, hey, you're not living up to your promise. You're not delivering these properties. It's not done on time. Why am I still paying? Why am I paying you for something that's not completed? And frankly, some of these builders are collapsing and they're never completed. So you end up putting down a deposit and paying 2 years worth of mortgages, and then your builder goes bankrupt and you have basically no recourse. So how would you feel about that? Well, how they feel about that is they are now withholding their mortgages, and they're doing it. It's not so much just an individual thing, but it's more of like a protest thing that the people are starting to say, until we get some building reforms and the government starts guaranteeing this stuff, we are not going to keep putting money into this broken system. Perfectly rational, reasonable thing to do. But when you consider the repercussions of that for the builders and the banks, what you're doing is you're cutting off their cash flow while they're in trouble and causing them to be in much further distress, which then causes projects not to be completed. Not only that, though, but if they're not collecting the income stream they're supposed to be collecting, how are they going to get new lenders to put money up? They're like, you projected these income streams, they're not coming in because people aren't paying their mortgages. And they're not paying the mortgage because you don't have the money to build the thing. It's just it's a whole mess. Then they collapse, and then the banks collapse right behind them because the banks were all counting on this money too. And kaboom. And just like in 2007, not 2008, but before that, but in 2006, I was pointing out to people how bad China was and what a problem China was, and everybody's like, for China, who cares? Other side of the world. Then it spread to Europe, and Europe started having property problems, and Iceland fell apart, and so on and so forth, and Greece collapsed, and everybody's like, oh, it's way over there, who cares? And then all of a sudden, like, boom, it happened to us. I mean, the only surprising thing was how people were surprised. I just honestly was dumbfounded by the whole thing. Because to me, I just couldn't believe that people were shocked at what was happening when it was coming. It was this slow motion thing that was happening over like 4 years, and it finally actually hit home. In fact, I sold my company in 2005. I had a real estate company, and I thought we were going to collapse in 2006. So in 2005, I sold my real estate data company because I felt it was the top of the market. The market went for another year after that. But I'm still glad I got out, right? You don't want to be with a hot potato. I mean, you got, and again, overvalued. Everything was being overpriced. Everything real estate was selling like crazy. So it was really easy for me to find a buyer and get out. And that's exactly what I did. I was like, I said, also it was the refinances were driving the market, and people were flipping homes, right? So they weren't even holding the homes. So I would do that. That's when it hit me. That's when I decided to sell. When I realized that we were doing the same report on a home 3 times in 1 year. So a house would go from one owner to another owner to another owner 3 times in 1 year. I was like, this is out. You got to get out, because those are my numbers, right? So now I'm showing these numbers, like, this is how many mortgage, this is how many mortgage jobs we did, this is how many refinance jobs we did, so on and so forth. And it wasn't realistic, though. You can't keep up that pace. You can't flip homes 3 times a year on a regular basis. It was speculation and insanity. It was a crazy time. We're not there. That's not happening now. So we're not, fortunately, our situation now is not like that, but we do have an unrealistic price of housing bubble. Prices are too much, and they'll come down, and people will get hit, but it won't be like that. That was complete nonsense. I mean, that was like a tulip thing, with the housing. It was crazy. Anyway, China is like we were then, though. China's having their own tulip mania for housing. They build entire empty cities. They build a whole city, and they sell the whole city to people and try to get people to move there and whatever. They build airports, railroads, blah, blah, blah. Not a single person lives there yet. And they build a whole city. And then it turns out that people don't want to live there after they build it, and they start rotting. And China's got like probably 20 something of these cities around the country that are just ghost towns. Because that's not how cities work. Cities grow over time and build naturally, and people move into town for whatever reason. Like maybe it's got a pretty waterfall, or maybe it's got like it's close to, maybe it's a good commute to New York or whatever reason somebody moves into a place. They move there, and then there's enough people there, and those people want gasoline, so somebody puts up a gas station, and there's enough traffic to support the gas station, and then a guy puts up a bagel shop, and then a guy opens up a deli, and a guy puts up a dry cleaner, and then those people are now living in the town. Then the guy says, oh, we should make a grocery store. They put a grocery store up. That's how a city comes into being. Over many, many years, built by the people who live there and the people who come in one by one by one. And eventually it hits certain sizes and things happen. If you ever played SimCity back in the old days, you know how this works, right? You've got to build these things over time. China doesn't see it that way. China decides how the city will be laid out. And then they say, this city is now open for everyone to come. And it seems like it could be kind of a good idea, right? You're like, imagine if they built an entire city like Jersey City, right? Which is pretty full. So let's say they take Jersey City and put it up by the Tappan Zee Bridge north of New York, right? Instead of Jersey City, which is at the bottom of New York by the Holland Tunnel. Okay, there's the Holland Tunnel, then you go north in the Lincoln Tunnel where Hoboken is, and then you go north to the Washington Bridge, and that's Fort Lee, New Jersey. And then if you go up from Fort Lee, there's really nothing there. But then you hit the Tappan Zee Bridge about 20 miles later, and you're 20 miles north of the main part of Manhattan. But frankly, a lot of people who live by Fort Lee go up the Tappan Zee Bridge and come back because it's less traffic doing that than trying to go over the Washington Bridge. So it's an underutilized way to get to New York City. So now, if there, for whatever reason, and there are cute little places up there, a town called Nyack and things like that. There's nice little places there, but they never turned into a city. It just the flow, the life, the people, whatever, it just never quite made it as a city. Across the Tappan Zee Bridge is I forget the name of the place, but anyway, there's Sleepy Hollow. I know that because it's Sleepy Hollow, so it's got famous. So Sleepy Hollow, New York is across, and there is a nice town that's fairly developed on the other side of the bridge. And then you're into the Bronx, and you go south a bit, you're in the Bronx. So that's basically New York. Anyway, so the point being that where Nyack is, if you said we're going to put a great big city here like Fort Lee or like Hoboken or Jersey City and put a bunch of buildings here and make more infrastructure and put some trains in, and then everybody's going to use it and then everybody uses it to commute back and forth to New York and also to become its own little hub of stuff like Jersey City. A lot of financial places have moved to Jersey City because it's cheaper and less crowded than New York. So you could plan it in theory, and that's what China did. So it's like, oh, maybe that's a good idea. But meanwhile, you're spending $1 trillion, $2 trillion, whatever the frick it costs to build a whole city. And then at the end, it turns out people don't actually want to live there. Oops. What am I going to do with the airport and the railway station and all? So, you built a city for 2 million people and only 50,000 people showed up. So meanwhile, while they're building it though, all these speculators come in and all these, and people legitimately want to live there, but there's, that people say, oh, I want to live there. I'm going to work in the city. They tell you there's jobs. They tell you there's this, there's that. Turns out the jobs don't turn up. And so the guy who thought he was going to open up a noodle shop in the city is now there's no people to sell noodles to. That doesn't make any sense. Yeah, if you look up empty cities China in Google, if you haven't seen it before, it's just a really interesting thing. It's just incredible that this kind of planning mistake could be made, not once, like 20 times. I guess they've had a couple of successful ones, and that's kept them going. And I think China's attitude is that eventually it'll catch on. You just got to give it time. They're patient people. But in the meanwhile, this is what's happening. So the whole concept in China though is build it first, then worry about whether anybody wants it. The speculators jump in because obviously there have been times when people have made a huge amount of money doing this stuff if it's a popular city. So people buy in, people want housing, they have a housing shortage too. There's very little affordable housing. There's all kinds of reasons people jump on these things. But the system is, you put a deposit down, you start paying your mortgage even though it doesn't exist. And there's the problem, because in the past, you would at least count on the builders to finish the job and get it done. But now the builders are failing, and they're failing because the empty cities are causing them to fail. The things they built and never caught on are now catching up with them, and they're defaulting on those loans because the people never showed up, and the government stopped supporting all these builders to pay for jobs that were never finished. I'm sorry, to pay for the jobs where nobody ever bought the properties. And so that's a disaster. And meanwhile, and by the way, while this was going on, China's debt swelled from like 10 trillion to 25 trillion dollars, something like that, some gigantic, crazy amount. What's ours? Ours is 32. They can't be as much as us. I don't know. I think they have some. It is like a huge amount. It's probably getting close. I'm sure they're at least 250% of their GDP in debt. Question is, what's their GDP? No, not 250. So that's Japan. So 150, let's say. It'd be more like $15 trillion in debt. I would guess their GDP is 10, and that their debt would be about $15 trillion. But it's so hard to tell with China what their actual numbers are. So anyway, so again, wouldn't immediately sink the market, but you start seeing this, and you got to start thinking we have to get into cash and protect ourselves. So this is one of my bigger concerns on the outside of the U.S. On the inside of the U.S., I'm concerned that these consumers are borrowing money to pay for all this stuff. There's a limit to how long that'll last. Of course, most of us who own homes, you have a good amount of equity now in your home because your home value has increased. But if the home prices drop 20%, which is what I expect to see happening over the next couple of years, if the home prices drop 20% to counteract the mortgages going up, then what you're going to see, because again, where's the money coming from? Back to the used car lot, right? If the mortgages are going up and the house prices are going up, then and the money that the homeowners have, that the home buyers have, is the same, they cannot afford to buy the house at that price. So if you want to sell your house, you will have to lower your price. There's no other way to sell it at a certain point. Just like stocks, right? If you end up in that situation where you're the person who bought the Volkswagen for $50,000 and now you're trying to sell it, except now $50,000 is 2/3 of the town's total income, or total reserve, or total money, or whatever, you will have no choice but to lower your price. It's not affordable. It's one thing to buy 10 cars or 20 cars for a stupid price, and that's how the stock market works, right? When somebody buys them for a stupid price and the stock price jacks up, it jacks it up for all of it, though. All the untraded stock goes to the same price. And then everybody thinks that that's what the stock is worth, but it's not, because go try to sell it and find buyers. Doesn't work that way. And so, our calculations for where the S&P should be are based on what can be afforded, what's reasonable for the economy, what's reasonable expectation for earnings, how much money is in circulation, what the alternatives are. What about gold? What about oil investments? What about real estate? Obviously, I'm not too thrilled with real estate. What is the alternative? That was another thing back here. We had a thing, and bonds. Oh, now bonds are coming back too. We had a thing back here where there was nothing else to invest in. Bonds were still 1%, 2%, 2% for 30 years. That's nonsense. That wasn't going to keep up with inflation, although now it's obvious, right? I mean, I was saying at the time, like, what kind of moron would give the government their money for 10 years at 2%? Inflation is going to be more than 2%. You're going to basically lose money on the bond. There's no other way it's going to turn out. It makes no sense whatsoever to do that. But unfortunately, there's so many people who, and I know you've seen this too, right? Where they've said, at your age, you should have 40% in bonds and 25% in stocks and 25, like that bullshit. It's all out the window now. You got to be on your toes to be a good investor. You've got to be a good steward of your money and make sure it's making money to keep up with inflation. Otherwise, it's losing. I mean, I know guys who have, $5 million in the bank, right? Or in, IRAs, whatever they've got in it. They're doing almost nothing with it. They make 3-4%, which sounds good. It's $150,000. It's not terrible. Their incomes are like $250,000, right? And they have $5 million saved up. And so making 150 plus the 250 you have is 400,000 a year. They're living very well. But at some point they have to retire, and it's hard to go from 400,000 a year to 150,000 a year. They're not growing the 5 million. It's not enough. You think it's enough, but it's not. You've got to have that money keep up with inflation, because and not doing it. And people are like, I don't have time. It's too much this. It's too much. I don't want to pay a broker fee. And meanwhile, I'm saying, are you crazy? If you could be making 10%, which is 500,000 a year on 5 million, you could be making 10%, but you're making 3%. $150,000 a year, then you're missing $350,000 a year. And you're telling me that the broker fee is what's keeping you from doing it? The having a financial advisor is keeping you from doing it? That makes no sense. You've got to put your money to work. You can't let it sit there. Not when inflation is chewing it up. And that's the thing about it. And so bonds, of course, are now a thing you could actually buy. They are up. How do we look at this weekly? Okay. So these are inverse, but this is when rates were 1% basically on a 10-year note, or less than 2%, 1.5, whatever it was. And since then, this is down, so down more than 10%. And now you're getting about 3% for a 10-year note. 3% is starting to be almost reasonable, not really reasonable, but almost reasonable. But when it gets to 5%, and now you can make 5% risk-free in bonds versus the market, which probably over the next 2 years will experience another crash and looks very shaky to people, then the bonds start looking very, very attractive. And then it becomes much harder to get people to put money into that Volkswagen, right? Now the alternative is now better than the $50,000 Volkswagen. So all the people who want to sell their Volkswagens suddenly find that nobody wants them, not for 50, not for 30. That's how markets crash. You believe that your stock is worth what you're paying for it now, but should the situation change and a lot of people try to sell that stock, that's supply and demand. There's going to be a lot of supply of stock and not a lot of demand for it. And that's how we had that waterfall sort of crash in 2008 that lasted for months, because everybody was trying to get out of the market and there were certainly not enough buyers for it. And that's why I always warn you guys, when there's a low volume rally like this one, you see this declining volume as we're going up, that's death. You do not want to be in this. Look at here, look the last time that happened. Look at this. See this thing? We went up, but the volume came down and down and down, and it was still higher than it is now. So it's going up, but people are buying 2 Volkswagens, 1 Volkswagen, no Volkswagens. It's not moving. You can keep pricing it up. You can keep changing the prices, but if you're not selling any, it's bullshit. And you're going to sell some, because it's not 100 Volkswagens in a town. You're not going to sell none. There's millions and millions of trades going on every day. Billions of trades going on every day. So everything gets traded a little. There's enough idiots out there, right? P.T. Barnum. There's always somebody who's going to pay some stupid price for a stock. And frankly, there's very few companies out there that don't have a buyback program where they're buying stock every day. So they always, and one of the reasons they do it is so that no matter what the price is, there's going to be some activity. They don't want to show somebody that nobody wanted my stock today. That's death. So a lot of these buyback programs are disguised in a way where every day at close of market, they buy X amount of stock. There's a lot of people who do that, and they do it to maintain activity levels in their stock. They don't want people to start catching on that nobody wants this shit at that price. Elon Musk is a master of that. He's always he's always pushing and pulling and whatever on his stock to try to keep it going. You know, speaking of things trading at 100 times their value. Anyway, so that's where I get concerned. And so those concerns are what has led me to, I'm halfway through the long-term portfolio. Oh, Fed minutes. How's the market reacting to the Fed minutes? Yay! See, the Fed minutes is saving us. Do we have to look at what they are? I really don't care. It really doesn't matter what they said, you know, a couple of weeks ago at their meeting, and how you're now going to interpret that versus how it was interpreted before. It's just silly. You know, I mean, and especially now, because now we know what they're doing. It's extremely well telegraphed. There's not going to be anything shocking in the minutes. FOMC minutes. See that? Wrong. The risk is on the hawkish side. I guess not. Fed minutes may point to rationale for size of future hikes. Dollar gains before the Feds. We have posted the minutes. Oh, they're so proud of themselves. It's like when your kid comes out, I made poopies. It's like, yeah, that's what you're supposed to do. All right, they're proud of themselves, so that's what matters. Give them a pat on the head and send them in. 2020, 2021. Here we are. Found it. Oh, what's this? Is this that economic statement? What is this crap? Oh, it's the minutes. No, so there's no economic projections. That's a shame. Okay. I like it when they have the projections. Minutes, blah, 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 blah. Ah, here we go. So keep in mind that this is from July 26th. Okay, we were not as smart on July 26th as we are today. We know a lot of things people on July 26th didn't know. Actually, no, not much has happened since. The deputy manager turned first to discussion of financial markets. Investors appeared increasingly attentive to downside risk, and that, see, here you go. Incorrect. Investors appeared increasingly attentive to downside risk of the economy. No, we have rocketed higher since then. On that, financial conditions eased modestly over the period, remain substantially tighter. Attach higher odds to the June survey, the possibility that we could enter a recession in the coming quarters. So what did they see on that date? They said that surveys of primary dealers and market participants, which is basically their beige book, marked down their growth forecast for 2023 and 2022 and 3, and they thought there was going to be a recession, because that was all the recession talk at the time was still funneling through. Even though I had already been on TV and told them that we were not having a recession, they didn't listen. Market participants see falling commodity prices for oil and the Fed's commitment to bring down inflation. Market-based measures, near data inflation declined and continued to suggest inflation would ease in coming quarters. It has eased a bit. In death surveys, respondents also expected inflation to decline substantially in 2023, but assigned probabilities of potential outcomes, including elevated risk of inflation. What? Okay, let's try that again. In the death surveys, respondents also expected inflation to decline substantially in 2023, but assign meaningful probabilities to a wide range of potential outcomes, including continued elevated rates of inflation. What? So some said it would go up and some said it would go down. I mean, that's a weird way to put it. Fast forward market-based measures, inflation compensation fell over the period. These measures continue to suggest inflation will return over time to the committee's 2%. Over what time? Be less vague. In their assessment of the policy outlook, market participants expected significant policy tightening. Respondents anticipated a 75-point increase in the target range at the current meeting. The most expected a 50-point increase in September to follow. So that's, oh, there you go. So that right there is what's, you know, if most expect a 50-point base increase in September, then that's good. Market's happy about that. They don't want another 75 points. The market implied path for federal fund rates policy around 3.4%. That is lower than 3.5 to 4% that people have been talking about. Significantly lower than at the time of the June meeting. The market implied path suggested expectations that policy rate would fall thereafter. Now, I've been hearing this. I don't see why. Why would it? I mean, go right back to where we were. It doesn't make any sense. Only if inflation goes below 2% for a substantial amount of time will they start lowering rates. Most respondents to the debt survey expected the federal funds rate to remain above the survey's long-term rate of 2.4% at the end of 2024, but on the average, oh, by the way, I'm sorry. So when I'm reading this, okay, the market implied path suggests the expectation the policy rate would fall forward, okay? So I say, oh, okay, well, that's only if rates go below 2%, and included in that, in my mind, is that that's not going to happen because we're rolling in $15 wages and we're nowhere near there. Minimum spell it right, minimum wage. Oh, minimum wage schedule for the US. Thank you, Google. Such a good assistant. The minimum wage by state, minimum wage laws, minimum wage tracker, 202 wages by state, state minimum wages, federal minimum wage, OPM, 50 minimum. Minimum wage by state and 2023 changes. How about that? Maybe that'll help. They're only into this year, unfortunately. All right, anyway, this is going on though everywhere and it's not going to stop. So anybody who's less than 15 is going to go to 15. And it's shockingly below 15, 725, especially if the Dems come. If the Dems get in power, forget it. It's going to be a national thing. And it should be, because 15 is still ridiculous. You still can't live on $15 an hour, but at least, you know, at least it's not psychotic like 725. I don't care if you are in Alabama, you still can't afford to live. So 725, 1024. So it's 50% up from here. Arizona, 50% up in how long? Okay, 20% up, 30% up. They got it, thank God. Oh, and by the way, when you're looking at it, you have to think about how big the states are too. So 10% of the country is already at 15. Okay, so Colorado's got room. Connecticut will be there next year. Delaware 50% away. DC is at it. Florida is 30% away. Georgia, what? It's like, what? This is why so many of my farmer friends are in Georgia. Hawaii 50%. Idaho double. What are they doing to these people? India, all these need to double. Double, another one, double. Maine, Maryland, Massachusetts is there. Fortunately, a lot of our, populated states are there already. 3. I mean, frankly, if housing was affordable, people would be leaving these states, but you can't afford to move. Double for these guys. Jersey's getting there. Another year away after this. North Carolina, North Dakota. Jesus Christ. It's shocking that this is still going on. Pennsylvania, huge state. Rhode Island, South Carolina, big state. South Dakota, Tennessee, Texas, big state. Utah, Vermont, blah, blah, blah. Washington State, West Virginia. No, Virginia is really the one with population. That's Virginia 11. Wisconsin. Wow. Really, people? That's sad. Anyway, so when I read this and they talk about, reversing, how are you going to reverse when most of the country is at least 30% away from having a proper minimum wage? So over the next 3 years, if they just go up 10% a year, that's going to drive 10% inflation. You're going to be stuck with most of this inflation for a long time. It's not going to disappear. It's not going to go to 2% especially because the 10% we had last year and the 10% we're having this year are stuck. So those wages that haven't moved are 20% now worse off in buying power than they were. And eventually people freak out. It does hit them eventually that they're being, economically disadvantaged, and they start listening to the socialists who are knocking on the doors in Tennessee and things like that. And that's when things start hitting the fan. Because that's what happened in the 30s. You had a depression. Then they pumped a ton of money into the economy to get things going again, not to mention World War II. But then everybody found themselves making these horrible wages when all the prices were still up. The prices didn't come back down. The prices stayed where they were. There's no more inflation, right? Inflation is 0%, but their wages were not there. So what happened? People started listening to the socialists and listening to the communists and joining unions, and all these things started happening. And at first, the embedded, I don't want to say the Republicans, but at first the embedded business interests would fight them off with sticks, and it would break up the unions and break up the commies, and we brought all these senators in to go chase the commies down and make sure we broke up all the organizations so they didn't start telling people to make a fair wage and things like that. And then eventually they capitulated. The companies started capitulating. By the time I was in the workforce in the 80s, you expected to get raises. It would always keep up with inflation. That was just embedded in the concept of working, was that your boss would adjust your wages to keep up with inflation. That was how it worked. Otherwise, you would leave the job. It wouldn't make any sense to stay in a job where your wages don't keep up with inflation, because people realize how fast you fall behind on that kind of stuff. All right, so what do they do after that? Well, then Nixon comes in. It was actually Reagan. Reagan comes in, he busts up the unions, and they start passing laws to stop them from forming again. And then they start a new cycle of oppressing the workers and keeping the wages down while corporate profits are driving up. All right, but they did get inflation more or less under control, so it didn't become a big issue again until now. So here we are 20 years after that, or not 20 years after that, 40 years after that. We're now back in a cycle where the inflation cannot be denied and it can't be swept under the rug, and you can't pretend that the $1,300 Social Security check is going to cover grandma's apartment and all her expenses and so on and so forth. It's bullshit. Everybody knows it's bullshit. So that's why when I read something like that, so all that is in my mind when I read that sentence. So it's bullshit. That's the bottom line. Most respondents expect federal funds rate to remain above the survey's long-run rate of 2.4% to the end of 2024, but on average, they place significant probabilities of lower rate outcomes. Okay, that's the respondents. It's not what the Fed says they're going to do. Regarding developments abroad, central banks and foreign economies had quickened the pace of policy tightening above target inflation. China just lowered their rates this weekend. 8 advanced economies, central banks raised their policy rates over the period along the lines similar to U.S. and nobody's raising as much as we are. That's why the dollar is so strong. Along lines similar to U.S. developments, market implied policy rates felt longer horizons that they would reach peak levels by 2023. Of course, everybody wants to reach the peak level by 2023. That'd be nice if we get everything under control in 6 months. It'd be great. In contrast, the Bank of Japan converted its commitment to accommodative policy. So the Bank of Japan and China, okay, top 3 economies in the world, US, China, Japan. China and Japan not raising rates. Europe not raising rates as much as we are. How are you fighting inflation in this environment? You can't fight inflation by yourself. It has to be a global thing. In this environment, the exchange value of the dollar appreciated further, surpassing its March 2020 peak. So they actually noticed that. Deputy Manager, next to discussion of money markets and debt, 75 basis point increase, passed through fully. The pronounced softness observed in the intermediate period of the overnight repo rates. Blah, 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 blah. Fed balance sheet, don't really care about their balance sheet, not really an issue right now, other than if it starts affecting the bond prices because they're buying less and less bonds, which is also pushing the rates up because you can still got the bonds are sold at an auction. The auction is how high you're going to pay the rate. That's the variable in the auction, how much money they'll pay you to take the bond. The bonds have to be taken. The guy sitting there with $150 billion worth of bonds to sell. Somebody's got to buy these bonds. They start out with an opening bid of 3%. Who wants to buy 10-year notes at 3%? Anybody, 3%, 3%, 3%. How about 3.02%? 3.02, 3.02. How about 3.04, 3.04? And it's auctioned off until somebody buys the freaking bonds. They keep raising the rates. So somebody might buy 20 billion at 3.04. Somebody might buy 10 billion at 3.06. Somebody might buy 20 billion at 3.08. You know, as they go up, a different person decides that's good enough for me. I'll buy them. I want to make sure I get my share. And that's how these rates are decided. But that's really the end of the Fed's ability to control things, right? They can hope that you're going to take them at 3% like they want you to, but in reality, there's an auction, and the rates are decided by the demand. And the Fed, if they're no longer bidding on these things, they aren't able to set the prices anymore. So they start going into the free market, and that's how Greece got destroyed. Once their bonds went into the free market and the free market started saying nobody wants these freaking things, that was the end of them. And rates started skyrocketing because same thing, you've got to sell the bonds. That's how much money you need to function. So they went up and up and up and up until they hit 20-something%. I mean, that was insane. The inflation availability, have the labor market very tight, labor demand remains strong. And see, that's why we also, again, no recession. This is what we have to watch, though. Labor demand. We start seeing that labor demand ease off, and we have to start getting concerned. Consumer price, PCE remained elevated, and inflation was also, by the way, productivity hard. I can't believe how bad the productivity report was. Total non-farm payroll employment, solid gain. Unemployment was 3.6, unemployment rate for African Americans, while Hispanics unchanged, blah, blah, blah. Labor force participation rate, unemployed population both ticked down in June. Less people are participating in the labor force. The private sector jobs rate, as mentioned by the job opening, labor turnover survey, declined but remained at a high level. That's the other thing we watch is how many layoffs and things there are suddenly. Nominal wage growth continued to be rapid and broad. See, this is the thing. Nominal wage growth, rapid and broad-based. So there's two things. There's a minimum wage law, all right? And you know how this works also, by the way. So the guy who has the shit job in the office or the floor sweeper or whatever, okay? When you're in an office, and luckily, by the way, this is also holding wages back from growing right now, We're not in an office. A lot of people are not in the office. When you're in the office and everybody is gossiping, and somebody who's working as a secretary in the office is making $20,000, and they find out the janitor is making $30,000, they get upset. And they go to their boss and say, how come the janitor's making $30,000 and I'm making $20,000 when I'm a secretary and he's a janitor, blah, blah. You guys have all heard this crap, right? And then the coffee machine guy is making this, you know, making that much money, and this guy's making that much money, and that one's making that much money. And every time people get raises, everybody starts expecting to be bumped up and so on and so forth. It cascades. And the reason that's not so much happening now is because everybody's kind of separated and you're all negotiating your own shit. And all these people working at home think they're getting away with murder, so they're not really asking for raises when they're working at home. But when they start making you come back to the office and start paying those elevated tolls and the elevated gas prices and the elevated parking rates and the elevated lunch costs that are hitting you when you step outside your house, when they start forcing you to deal with that 5 days a week, you are damn sure going to demand a raise. So that's wage pressure. Also, if you want to hire somebody, okay, you guys are all seeing this now, right? You go to a Burger King or a McDonald's or a Taco Bell or whatever, there's a big sign out front that was done by professional sign people that says, you can be here and we will help you with college and we will do this and we'll pay you $15 an hour and $18 an hour for the managers and blah, blah, blah. And all of a sudden it's like, holy shit. They got me doing the math going, oh, I could go to McDonald's at night. How much I work 4 hours a night and make $100? Yeah. It's like I make $500 a week going to McDonald's after work, you know? It's like, why not? Got nothing else to do. So, you know, I mean, and this is how it works. I mean, they have to attract people, and they're competing with everybody else to attract workers, and there aren't enough workers to fill the jobs because we don't have any immigrants anymore. That's millions of people who used to be able to work who can't work here anymore. So you know, it's an artificial labor shortage, and there's a lack of supply. So supply and demand is now in favor of these workers. And the only thing, and it's been slowed down though from what it would be a crisis, frankly, except people are working at home. But the problem with people working at home apparently is this productivity thing was terrible. I don't get that. Maybe it was because it was the summer and people were just taking more time off or something. I don't know. But we had such horrible productivity numbers. Anyway, real goods edged down in May, blah, blah, blah. Exports and imports of services can be held back by incomplete recovery of travel. The international trade deficit declines, exceptionally strong March. The nominal international trade deficit narrowed. That doesn't matter. The available data, blah, 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 blah. Suggests net exports contributed positively to GDP. That matters. Consumer price inflation, 6.3%, 12 months. Core PCE, 4.7. Trimming measure of 12-month PCE, 4%. So they're making up numbers now. In June, the 12-month change in CPI was 9.1, while core inflation was 5.9. Survey-based short run, elevated, blah, blah, blah. Available indicators suggest real PCE rose at a modest pace. Manufacturing output moved lower, so costs are up, output is lower. And forward-looking indicators of manufacturing weakened broadly. This is all before the productivity report, which was a disaster. Foreign economic growth slowed notably. Blah, blah, blah. Indicators for June, so still a war. Indicators for June showed the China economy rebounding. No, it's not. Global lockdowns are eased. No, they're not. The global economy, however, continued to face headwinds, disruptions, blah, blah, blah. Although most commodity prices moved lower. Recent weeks, foreign consumer price inflation was rising, and because their currencies are weaker, dude. June, mostly reflecting past increase in food and energy prices, but also continued broadening price pressure of core goods. Many foreign central banks tightened monetary to address high inflation. So they've got to catch up to us Otherwise, the value of their dollars or whatever is shit, like this. Here's us, here's everybody else. That's the story. That's the story of the last 2 years. 90 to 106. That's what, 17.5% basically. That's 17.5%. 120 or 122 to 102. That's horrifying, right? So again, here you are with your retirement money, $500,000, and the euros that are 500,000 euros, and now your euros are worth 20% less than they were. You lost $100,000 of buying power while you were sitting there. Especially when you're sitting there, if you got one of those 2% bonds, you're screwed. Is that the worst? England? No, England's not worse than Europe. New Zealand? No, nobody's worse than Europe, I don't think. Nope. Swissies? Nope, can't be that bad. Canada? Not even Canada. Canada's actually doing well. So no, Europe is the worst. Europe is basically exactly gone the opposite way of the dollar. They're worse than Japan. That's crazy. That's like, you need a new government. If you're worse than Japan, you need to change everybody and everything. Because Japan is a total disaster. I can't believe Japan's not bankrupt. I really can't. At this point, it makes no sense. They're 200. They're probably well over 250%. They were 250%. They're probably closer to 3 now. But they're at least 250% of their GDP in debt. Okay, so that would be like America at 24 trillion. We would be 48, and 12 is 60. We'd be 60 trillion in debt, which is double where we are now in debt. So that would be like America being $60 trillion in debt. And that would mean the interest on the debt at 3% would be 1.8 trillion. So in other words, half of the tax money collected would be going to interest on the debt. That's the situation in Japan. Okay, they probably collect a little more tax money than we do per person, but you know, if it was the US, half the tax money we collect would be just to pay the interest on the debt. How are you going to survive like that? Are you going to double taxes? This is not to pay down the debt. This is to pay the interest on the debt so you don't default. So are you going to double taxes or cut 100% of your spending? Those are your two choices. You could raise taxes 50% while reducing spending by 50%. Maybe that would help, but it really wouldn't. You're just screwed. There's no way. And that's what countries do, right? They basically raise taxes and lower services, and this is when you say, oh, the country's falling apart, right? That's what happened in New York in the 70s. They raised taxes. They made it very expensive to live in. They hit up people with a lot of different taxes and things like that, which is still there now, frankly, but people are used to it now. But back then, that's when they started pushing all these different taxes on people. And at the same time, they cut all the services. The police weren't there. Crime started spiking up. The subways were disgusting. Garbage was in the streets. It was just a disaster. And that's what happens. I mean, there's a reality. There's a reality to a budget. And some countries can print their own money and get around it for a certain amount of time until people just rebel against it. But that's what's going on. I mean, that's what's going on in most countries. They printed the crap out of money. And because everybody does it, it's kind of accepted and nobody calls anyone's bluff. But one day someone will call the bluff and the whole thing will collapse. And you're going to have, will everybody default or will they absolve all debts? Who knows what's going to happen? But we can't keep going on like this. You can't keep going on pretending that a country like Japan, where 1/2 of the total tax revenue of the country is required just to pay the interest on their debt, you can't pretend that that's a functioning country. What if rates go to 6%? Then 100% of the taxes have to go to pay the debt. Otherwise, they're in default. And if they're in default, then the rates go to 9%. And then they need another whatever. Then they're going to need to collect triple the taxes just to pay their debt, just to pay the debt service. Forget running the country. Running the country's out the window. That's gone. That's like zero. As I shut everything down and tax the crap out of people just so we don't completely default. But so they're going to default. And who knows, nothing has ever happened on that scale before. But there's no, again, how do you get around it? Your choice is to get around it. Raise taxes 100%, cut spending 100%. Those are your two choices. Over the intermeeting period, nominal Tread yields declined significantly, reportedly affecting increased concerns, downside risk to growth market, blah, 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 sovereign yields, market implied federal funds path, broad equity prices, were higher while credit spreads widened. Major foreign policies index edged higher. Don't forget they're not doing another meeting until September. So everything that they're talking about now, we have to wait another month before this actually matters. That's why this thing is not important. So it's in between meetings. Broad equity price indexes were higher, heightening volatility. Declines on interest rates likely supported stock prices, while some positive earnings suggest investors less pessimistic corporate outlook. 1 month option implied volatility. The VIX decreased but remains slightly significant. Now the VIX is down quite a lot. Yields on corporate bonds declined. Spreads on municipals. Conditions in the short-term funding was stable. Investor concerns about global economic growth intensified. Weaker data, which is still weak and terrible. Sovereign yields, midterm inflation expectations, most notably euro area, just like I just said, went down with yields largely reversing a sharp increase that occurred before the meeting. The euro area peripheral sovereign spreads were little changed following widely anticipated announcement of the ECB with the transition. Major foreign equity price indexes were volatile, but generally were higher with us. The dollar appreciated somewhat further against most currencies, particularly against the euro, as yield differentiations. Most Latin American countries depreciated against the dollar. Everybody depreciated against the dollar. And again, because we pay more interest, so you're going to put more money in dollars. If we're paying more interest, Fed tightening, we're paying more interest than the alternative. The dollar seems like a safe currency compared to the alternative. That's where you put your money. Not complicated how this thing works. Long-term borrowing costs declined over the intermeeting period, but I don't know when these things decline. They're certainly back up now. Credit quality, households remain stable. Credit generally available through credit availability appeared to tighten. Borrowing costs linked to shorter-term interest rates increased. Small businesses borrow on a regular basis, notably higher borrowing costs. That's what I'm seeing. Interest rates on most existing credit card accounts and loans continue to trend upward. That's also very dangerous. In contrast, I think we have like 1.7 trillion in credit card debt. In contrast to many other borrowing rates, residential mortgages rates fell since the June meeting in line with the longer term spot rate. That's the other thing. People don't understand how your credit card rates go up, and because it hasn't happened in so many years, and people don't get how high they can actually start going. Oh, and people have to start paying back their student loans. That money's going to start coming back because people have been on hold for the student loans for a long time. May, the volume of downgrades, speculative grade credit bonds was similar to that of the upgrades. Volume of downgrades exceeded the volume of downgrades in May and June. The credit quality for the CREs, blah, blah, blah. Delinquency rates on loans declined. Delinquency rates on businesses were little changed. The credit quality of households stayed solid. Residential mortgage delinquencies trended down. Credit card order credit delinquency rose somewhat from the first quarter, but subdued. So none of that was bad. Business loans at banks expanded at a rapid pace despite the higher rates. Yeah, because you're borrowing before it gets even more expensive. You gotta, people, that's what people do. It also goes for the homes, right? This is the last gasp of people rushing to get homes before it gets too expensive. Credit appeared to be available for most small businesses, although the share of firms reporting is likely to change. Credit and residential mortgages remain continue to fall. Consumer credit remained broadly available. Blah, blah, blah. Staff provided, blah, blah, blah. Equity and corporate debt prices. They're repeating now. Staff assessment of households better positioned than in the mid-2000s. To weather downturn in house prices, nothing that mortgage debt growth has significantly lagged in growth prices, leaving households with substantial equity cushions, as what we just talked about. Unless the housing corrects, then that equity cushion goes away. Moreover, much of the past decade, most new mortgage debt has been added by borrowers with prime credit stores. In addition, the staff assessed the business leverage was high, but businesses had ample cash on hand. Credit quality remained strong. Further, the ability of most firms to service their debt was historically low as measured by the interest ratio coverage. That's because we just freaking put $11 trillion into the economy. That's why everybody's got this liquidity. When that goes away, then what are you going to do? Recent declines in capital ratio due to higher liquidity. Liquidity deteriorating, oil and equity. Okay. Economic outlook. Projection for the economic activity, blah, 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 blah. This is all the same stuff, basically. 2.2, staff continued. The risk to baseline projection was skewed to the downside, noting supply chain bottlenecks. Those have gotten better. Russia's war against Ukraine still going on. Weak incoming data on spending, not so bad, actually. The tightening in financial conditions in the start of the year supported by the assessment. The staff viewed the risk of inflation projections skewed to the upside. Given the thing, yes, inflation is still bad. The possibility of inflation expectation become unanchored over the past year. In their discussion of current, wow, these are extensive notes. I mean, this is longer than usual. Job gains were robust, blah, blah, blah. Participants' Russian war against Ukraine was causing hardship. War and related events were creating additional pressure on inflation. Of course, against this background, they were highly attentive to inflation risk. Consumer expenditures, housing, business, and manufacturing all accelerated from robust rates. The labor market, however, remained strong. Participants observed that the economics indicators of spending suggested that the second quarter's year had been broad softening in the economic activity. Many participants remarked that some of the slowing, particularly in the housing sector, reflected emerging response of financials, the unwinding of large-scale support to the consumer spending and provided pre-pandemic, the Inflation Reduction Act, and the move to demand for some products elevated levels in the earlier stages of the pandemic all led to slower growth in household expenditures, in addition to deterioration in foreign economic outlook. Strong dollar contributing, a weakening of external demands. Participants anticipated that the GDP would expand. Oh, God, it's below trend GDP growth, blah, blah, blah. Household sector participants commented they were seeing signs and data. Slower growth in consumer spending. We're not really seeing that, though the aggregate balance sheet for the household sector was strong. They also observed housing activity had weakened. That's definitely happening. Participants anticipated slowdown in housing activity. See, what you want to do is figure out what they thought was happening and what's actually happening since then. Durable goods was better than they thought. Because don't forget, I keep saying economorons. I mean, the bottom line is these guys are so wrong in their outlook. They're just missing things by miles. And you got to try to remember which way they missed each thing and whether that matters in one way or the other as to where it's going. Major supply chain disruptions, these are going to continue. Like I said last week, the Port of Los Angeles has improved drastically better. And that's, it's a good indicator for what's going on in the country. Spending production, less underlying strength. Hearings. Holy crap, I cannot believe how much they're writing here. Oh my God. All right, I'm bored. And then we get into the action statement. Okay, so bottom line is they are in general a little gloomier. So it is, yeah, this is positive. And because if they're gloomier than what really happened since, then that means that they're less likely to have a reason to do anything other than be a little less tightening than there was. So we have this nice little move back up. But still, it's not like we expect it to go much higher. 4,300 is where we expect to be. So we got rejected and we came back to it, but the same line, it's this line right here. I don't know if it's going to update this much. Yeah, see, now it's got a little space in the box. But this is where we are now. The declining 200-day moving average is going to, it's basically striking us right here, right? So the declining 200-day moving average, which is in fact 43.24. So it says 43.24 right there. So 43.24, so a bit over 43.20. So we're right at this intersection here, and it's hard, especially the first time, to get over that. So you're going to get at least a weak retrace. A weak retrace of what? Well, certainly a weak retrace of this move. So this is what? 3750 and 4300. So actually it's 43.25. So let's say 43.25 minus 3750 is 575.2. So 115 points. So basically from the 4300 line, call it 100 points. And that means that we'd be looking at 4,200 and 4,100. Those are our, wait. Is that 100 points? Am I crazy? 4320, 4,200. That's 100 points. So this is a weak retrace, it's 4,200. And again, I'm rounding and making it simple, but I mean, the simple concept is you're going to get a retrace of this run, because this run happened without any real consolidation. So you're going to get a retrace of this run. That's just like this retrace. This was a weak retrace. It held and we popped up. So if we only have a weak retrace to 4,200, that's a good sign. If we hold 4,200 and start moving back up, we have a very good chance of popping through this. If, however, we fall back to 4,100, which is a strong retrace, and we start consolidating, then it's more likely we're going to test the 200, which will be rising. All right. So it depends on what happens. Now, it doesn't tell us what's going to happen. It tells us what is likely, where we're likely to hit the resistance point. So the weak retrace here, it would be good and healthy to come back here, consolidate here, and then take a run. As the 200 days going lower, we pop over it, and then we're into some good territory. But now we got to step back and say, well, that would all be great, but I don't believe that we deserve it. I don't believe that that's the value. So I think what's more likely to happen is we're going to come down. We're going to test 4,200, but if we're at 4,200, this is still going to be dragging lower, right? Then we're going to try to get over it. We're going to hit the 200 again. We're going to go below it. We're going to get to 4,100. And that's the middle of the range we expect to be in. And by then, the 200-day will be coming down. And then the 50-day will be coming up. And we're going to start squeezing between the 50 and the 200. And then hopefully we can get over and make a top of the range. And then you start getting to a more positive scenario where the 50-day moving average is above the 200-day moving average. It's a much healthier chart. You know, it's going to be a lot healthier technically to be in that position, and we can start moving and repairing and getting ready to move into a higher area, assuming that we can justify it in Q4. Talking about Q4 at this point, though. But for the rest of this year, this was our expected range. We expect the range for the year, 400 to 4,300, 4,000 to 4,300. That's the range we expect for the rest of the year. Because this is where we are fairly valued. And again, assuming the war doesn't end, assuming inflation is about the same, which it is, you know, we'll see what happens with the elections. Also, you don't know what's going to happen with the elections. That's in November. But other things being the same, there's no reason for us to really be above this red line for a while. So I didn't expect it, which is why we started getting a little bit more conservative with our positions, and that goes back to where we were. So then we were reviewing our portfolios, and I'm just looking to have less risk. So I'm looking at each position and I'm saying, how do we reduce the risk of this piece. And so we're so the changes we make are we're doing extra covers where we don't have covers before. We're adding some covers. Well, we didn't be able to change anything here at all. We bought back, well, that's AT&T. We bought more. Here we added more shares. Well, this is the opposite. Well, I wanted to cut back, but this is such a good portfolio. Which one is this? This is dividend portfolios. Oh yeah, because that's already super conservative. So there's really nothing to change because it's such a boring portfolio. It's super conservative and it made like 40% in the last month. But that's, you know, it's accidental. It's a function of the VIX and a function of the market popping up like it did. Long-term portfolio. Well, here, let's see how much damage. Okay, so we did this. It was 2.6 million. And if we go now, probably still around the same. If it ever works. There it is. 2676. So what was it? 2642. So we're up $30,000. Even with all the crazy stuff going on today, we're up $30,000 from where we were at that time when I did this, which was oh, I don't know. It was in the afternoon anyway. I think it was around noon I started working on this. So in the long-term portfolio, okay, see here. So when I look at the long-term portfolio, I'm like, oh geez, we got like 40 short puts. And I know, and this is why it's important to go back on these things. I know when I look back on the portfolio, these were a problem. These were almost all red a month ago. Okay, and they weren't killing us, but it's annoying. So I said, okay, let's see what I can eliminate. So what do I want to cut? And the way I'm looking at it is I'm going through them. I'm saying, okay, well, he's up 60%, so let's get rid of him because they're all a risk, whether you want to think so or not. Well, I'm sorry, we didn't get rid of Apple because it's Apple. Like I'm not going to pay 25 here. I'm not going to pay $2,500, right? Because I had to pay 25 to close it. I'm not paying $2,500, so you don't assign me Apple at 105 minus the 2,500, which would be $5 less per share. Because it's $250 less per share. So 102.50 would be my net on Apple because I would have to spend this money otherwise. So I can either, because this is as if I sell the put right now for 250, right? So I can either at 102.50 in September, which I want. You want to sell me 1,000 shares of Apple for 102.50 when it's at 170 now? I'll take that, thank you. So I absolutely want Apple for that price. So I'm not going to pay $2,500 not to get it. So I'm keeping that one. But that's a rare one. That's just because it's Apple, and I know I can find a use for Apple at some point. But AWW is up 92%. It's not that there's a risk. It's not that I don't believe in it. It's just that why take any chance at all on that? I get to clear. I have more margin to work with. I'm not going to take a loss. I'm locking in my $5,900 gain. So I got no reason to stick with this thing. I almost killed Alaska Air, but I just thought about how much I like them and I wouldn't mind owning them long term, and it's 20% below the current price, blah, blah, blah. But then you get to like Amgen, 75% up, and other biotechs are underperforming, so why should I take any chance? Again, it's 175. I'd love to own Amgen for 175, but it's up 75%. I'm not going to risk it for $2,500 and wait till 2024 to collect the rest of my money. That's another factor, by the way. These Apples expire in September. It's not like I'm waiting until 2024. It expires in September. And so I went down the list like that. Is there anything at all that bothers me about these stocks? Banco Popular, and like it's a bank. Who knows what kind of trouble they can get into? Who knows what happens if the economy falls apart? So 60% is fine. Take it off the table. Don't wait. So I went through them like that. Here's Chimera, which I don't know if we kept it or not. I mean, we already have the stock. Anyway, so I went through them like that, and I decided the ones that we're going to cut were Amgen, Air Products, Banco Pop, like I said, Caterpillar. Oh, and Caterpillar I cut not because I don't like Caterpillar, not because I don't want Caterpillar, but it's an expensive stock, so it's using a lot of margin. It's hurtful if it does go down, and you know, there's no reason to risk it. David's Tea, I didn't like what they were talking about in the last time I heard the management talk about something. Their strategy to me was like not good. They're going like a, see, to me it's a tea shop, right? So they sell, you know, they were in malls for a while. They're gone now, but they were in malls. They unfortunately expanded to a lot of malls right before COVID, and that hurt them badly. And now their strategy, though, is to stay digital, to stay online. They want to be a big online tea place. And to me, I don't see that. I don't think I buy a lot of tea, especially their kind of tea. Their teas are weird and expensive. So I'm not going to go and buy David's tea at the higher price when I'm not even at the store trying it or so on and so forth. You know, it's just not the same thing. I think online you end up drifting towards a lower price. In fact, I just bought my matcha tea. So I bought it on Amazon, and I bought the first one I bought was it was expensive. It's not really expensive though, because you use so little of it to make the tea. But it was expensive. And then the next one I bought, it was like I bought a restaurant tin. Since I now decided I'm going to always make matcha tea, I bought a restaurant sized tin, and it's the same organic, but it's not the same quality supposedly. And I just bought it to say, well, could I tell the difference? Because like one quarter the price. And I'm like, can I tell the difference? And I tasted it, and I'm like, I can't really tell the difference. I'm doing side-by-side comparisons and things like that. And I'm like, I'm sorry, I don't see enough difference to pay 4 times more money for the organic. There's a ceremonial blend. The ceremonial kind is quite a bit more expensive, and there's a restaurant quality, and the restaurant quality is fine. And I realize that, because I'm sure that all the Japanese places I go to, when they make me matcha tea, I'm sure they're not sitting there taking out a special ceremonial blend to make my tea. I'm sure they are just using whatever's in the kitchen. Anyway, FedEx. Also, again, when they're a high price, if you get assigned, it's a lot more money. So you lower the assignment risk is a big, big step to taking out the problem in your thing. Now, FedEx, if the economy does go into recession, they're sensitive. 5 is a high price. I'd rather get Dollar Tree or something like that. Foot Locker, we already have in a bunch of places. Frontline is up 60%. Halliburton's up 60%. IBM. I love IBM. They're up 60% already, though. It's got to wait till 2024 to collect 40%, and it's taking up space. So no, KBH, the home builder, rough environment, pets.com. Sorry, I had not pets.com, but pet meds. They're just not making enough progress. So I'm looking for things to cut. So they don't make the cut. Toyota is an expensive stock. Ford has better options by far. In other words, you know, here's Toyota. So if I have Toyota and I have a spread, let's say I've got, they're at 161. So let's say I buy the 150 is 20, let's say $25, and the 200s are, well, I wouldn't do that. The 190s are 10. So let's say it's $15 for the $40 spread, okay? So it's a 150, 190 spread, and let's say I can manage to get that for $15 net dollars. That's a nice little spread, right? And then what can I sell it for? I can sell the October, where are we at? 160s. So I can sell the October, wow, these are super thinly traded. Well, that's problem number one. Look how thinly traded these are. All right, I can sell the October 160s for 650, let's say. They're close enough. So let's say 650. So that's 650 out of 15, but that's at the money. It's actually a little bit in the money, okay? Now, if I do with Ford, do the same thing. So with Ford, I get the $15 calls for 4 something, and I sell the $22 calls for $2. So let's say it's a little more than 4 and a little less than 2. So let's say 190 and 420 is 230. 230. So for 230 for that spread, and let's say I sell the October at the money, 16 calls for $1, right? Or $1, actually it's $1.15. So now I say 115 divided by 230 is 50%. Don't need to really do that. And then on Toyota, it was 6 divided by 15 is 40%. All right. So this is what I'm thinking. So when I say that, this is what I mean. I'm thinking if I do the same kind of spread with Ford, I got the same upside, but I'm deploying obviously lower money per share, so I'm carrying much less risk on the downside for my put options. I don't mind owning Ford. I feel very comfortable at them having a bottom. So if I were to sell puts, and let's say I sold like the $15 puts for $3, I'm not going to kill myself if I end up owning a ton of Ford for $3, for $15, and I'll roll it down to 12 eventually, and so on and so forth. So I'm not worried about that. Toyota, and that, by the way, was obviously a very significant. It was more money than the spread would have cost me, right? Now Toyota, for me to get $15 back, I would have to sell the 150 puts. Well, 150 is a lot of freaking money. And so it would be kind of burdensome if I got stuck with $150,000 worth of Toyota, and I don't have quick ways to cover it, and so on and so forth. So therefore, even though I love Toyota, even though I think it's a great value, there's too many things where I could say, well, you know what, Ford is better for me. So that's it. So I end up saying that's why I'm cutting Toyota, not because there's anything wrong with Toyota at all, just that Ford is better. And I know it's like weird when you got a portfolio, it's like $2.5 million or whatever the hell we're at. But it doesn't matter. Money is money. You gotta, I mean, you're talking about pretty big differences, 20% difference in the options efficiency. So that's what we do. So that's how I'm going through all these. I'm looking at them and saying, is this really right for where we are now with Boeing? So in Boeing, we were uncovered, and we had this nice run, and I do think it'll go back to, I think they're good for 250. But you know what? If I sell the 170s for 17, I can roll. In fact, I said that here. I said 250 is a good target. The 2024 250 calls are $11. So we can sell 10x of something for 22, and that would be a $4. Oh, I see. We could sell 10. Well, so we can sell. So in other words, we have 20 open slots in Boeing, just so I don't want everybody to get confused. So here's Boeing. It's uncovered. We have 20 open calls. So I'm saying, I think we're going to go to 250. The 2024 250 calls are 11. So if I sell something shorter and it's 11, then I can almost certainly roll them to the 250 calls. But I decided I'd rather have a little more protection. So I'm going to take the January 170s that are 17, which is right where we are now, and that would make me feel better. So first of all, I know that premium is going to burn off, right? It's all premium, and it's all going to burn off. So even if Boeing does go higher, the premium will go down. So it would have to go to, obviously, would have to go to 187 before I even have to give them back their $17. So 187, it'll still be 17, and I could pay $6 to roll up to the 250s. But of course, the 250s will also be higher in price, so probably less than $6. So my mistake in the worst case would be a $5,000 mistake that I pay to roll up. But if all goes well, this premium burns off. We're still somewhere in the 170, below 170. This premium burns off, and I get to sell another $17 for the next 6 months. I make another $17,000. And then once I can sell the 250 calls, I'll cover fully. But for now, I don't want to cover fully just in case, for whatever reason, Boeing pops. Anyway, so, oh, it's 3 o'clock. Yeah, I got to cut. So that is how I'm going through all the portfolios, and we're already done. I mean, we're not done. I still got to finish the long-term portfolio, but because we're 1/3 through the long-term portfolio, but I'm going through every position like that, thinking really hard. Can I get my money out? That's my first thing I'm looking at. Can I cash this? Can I cover it? Can I do something to get money out of this position? Because I want to be protected, I want to move into a covered call situation rather than having open longs, because that's what we did that already. We did that and we made the money. Well, not you. Go away. Ow. It's in the place that I'm trying to go. So we did this last earnings and we made the money. We had the move we wished we had. We're done. It did exactly what we want beyond our expectations. So now all the stuff we uncovered, and like I mentioned earlier, we had 2 different reviews of the long-term portfolio in order to make all the moves we had to make. We had a move on June 30th. Okay, so here on June 30th, we made a whole bunch of bullish moves. And then on July 13th, 12th, whatever, we did it again. And we did the rest of the ones only because I felt more confident as we came. So we came up, we went down, we came back to here, and we were holding it. And I said, okay, I'm going for it. We're gonna uncover all these things, because you know what? This made me regret not going forward here, which was a line we knew we should be at, right? So we knew this was a line. I didn't get aggressive enough here, and it popped, and I was regretting it badly. So no, when we did our reviews here, we got aggressive, but not super aggressive, because I said, well, what if the strong retrace line doesn't hold? Then we're fucked. So we were looking at it that way. So I was being cautious here, but we got a bit aggressive here. We had this run, and I was so regretting not being more aggressive. Then we came back here, we retraced half, but it was holding. So on June 30th, I said, oh my God, let's not miss this opportunity again. Let's start getting more aggressive in the LTP. We got more aggressive in the LTP. We went back up. We fell back down, but we held again. And so on this day, we did our long-term portfolio review. And I'm like, screw this. Let's take the rest. Let's be aggressive on as many positions as were reasonably possible to be aggressive on. And we had a massive run, and we made a shit ton of money. But now, I don't know which way it's going to go. In fact, I frankly feel that this is probably not going to go any higher than this. Therefore, why would I not take profit? So now I'm looking at the same way I was looking to get long on anything I could. I'm now looking to start cashing in anything I can, or at least covering it and turning it into a trade that can stand up to a pullback. I don't think we're going to fail. I don't think we're going to go back into this end of the range, but I don't really believe we're going to go up here either. I think this is where we're going to be. And so this is the top of the range. And if you don't know to cash out at the top of the range, you shouldn't be trading. All right, so that's where I'll finish this lesson. And does anyone have any questions? And if you do, tough luck. Tarrytown, thank you. Jason and Sandra both knew that one. Sandra from Nyack? No shit. I lived in Nyack once. Yeah, I lived in the apartments like right on the water near the bridge. There are apartments like pretty close as they stick out. I lived there for a little while when my parents first got divorced. And what was I, 7 years old? So it must have been 1970. I lived there in 1970, just for like a year. I think it was a year. Anyway, all right, well, thanks for coming, everybody. I hope that was a good lesson. And we'll do it again next week. All right, take care.